Today's presentation, we're going to be talking about how high inflation right now is affecting your taxes this year in 2022 and also in future years, because we know that, again, high inflation now will affect the trajectory of our taxes moving forward into the future. We've talked about this a lot in past videos. We're going to be bringing back a couple of those given concepts into this video here today. So it's no secret for a lot of you that have been paying attention to this that inflation is running very hot right now. Looking from December 2021 back to December 2020, a 12-month change, the overall CPI adjustment is 7% on all categories. Now, they'll also split this out into further granularity here, looking at food inflation, energy, and then all items less than food and energy. And we see on the screen here that energy inflation is running into that 30% zone, looking at gas, looking at cost of heating homes, things like that. But even after leaving out food and energy, we're still looking at inflation pretty hot, really across the board. There's not necessarily one given category that's certainly raising inflation that high. And there's a lot of disagreement as far as if this is transitory inflation, if we're going to see inflation continue. I'll let you in on a little secret. No one knows, okay? Inflation is a hard topic for even economists to understand and try to predict. So we really don't know what inflation is going to continue with moving forward into the future. I know that doesn't offer many of you a lot of confidence, but again, that's just the reality that we have here. And so when we break these out into different baskets, into different categories, CPI, for instance, is made up of, it's generally looking at a basket of goods, a basket of general things that people buy and purchase on a regular basis, and then tracks that through time. And so when we break this out into those sub-basket categories, we see that really across the board, there's a lot of things that are that inflation is really affecting. It's not just necessarily one category. Now, for instance, gasoline, energy is one of those that is certainly the highest inflation rate overall that we've seen over the last 12 months. But nonetheless, we see this across categories. So what I did is I drew a 5% inflation line here because, again, the axis is a little bit difficult to see here. And we see that the vast majority of goods within this basket are above that 5% inflation line. This is, for many of us, some of you might remember the 70s and whatnot, where we saw high inflation. But for the last couple of decades, inflation has been pretty low, pretty calm, 2 to 2.5% range. And so this is the highest inflation we've seen in decades. And so there are certain categories that, again, affect different types of people. Retirement is certainly the focus of our group, the focus of our channel here, if you're watching this on YouTube. But if we look at some of these categories that specifically are affecting retirees, there's not a lot of room for you to affect your budget and try to find a safe home away from inflation. For instance, a lot of us will use gasoline, okay? Energy to heat our homes. Okay, utilities, meat in general. Again, new vehicles, not so much. Tobacco and smoking products, hopefully not so much. But then food, okay, electricity. Okay, a lot of the items that aren't affected as much are items that, again, we can do away with. Again, airfare, airline fees, education, again, medical care, which is one that's been significantly higher as of late. We're actually seeing lower than, again, what I would say the average inflation rate, but really no place to hide when we talk about inflation. And in this video today, we're going to be bringing back in some of the concepts that we've talked about and maybe some past Wealth Wednesdays along something we call stealth taxes. So there are parts of the tax code that adjust to inflation moving forward, and there are parts of the tax code that don't adjust to inflation. And it's very important to know and include in your retirement plan those parts that don't adjust to inflation or adjust at a slower rate, because those are given tax hurdles that we really need to be focusing on and thinking about, because we can slowly creep in to those given tax hurdles. This is something called bracket creep. If we have a tax hurdle that doesn't adjust to inflation, well, over time, if we're adjusting our income and we have certain assets like Social Security that are adjusting to inflation, we're slowly being pushed into higher tax zones here, okay? And so bringing in a lot of those concepts, but just know that as I've noticed with a few other videos that we've posted, inflation can be a fairly controversial issue. And that's because really what the government is trying to do with CPI is they're trying to include a basket of goods that broadly applies to most individuals. Now, we know that everyone's inflation rate is going to be slightly different based on the goods and services that you purchase. So CPI by definition is going to be kind of a poor rule of thumb. But even inside of CPI, there are certain parts that lead anyone to question if inflation is accurately being measured right now. Home and really home costs, shelter costs is one of those items. So for instance, in CPI, there is a certain percentage. I believe for shelter, it's up to 40%, but they look at, I believe, 24% allocated to looking at home prices. And so that's something already when you have a static percent that builds into inflation. Already we're at a probably a miscalculation, because let's say that everything else that meets in or that is totaled up for inflation. Let's say that home prices are we're seeing, let's say, just again in a crazy hypothetical example, 100% inflation on home prices, and everything else is essentially a lower normal inflation. Well, right off the bat, we know everybody needs a shelter. And so holding a static rate, let's say 24%, already leads to a poor inflation calculation. The other thing to mention too is that the way that they calculate equivalent rent for those that aren't homeowners, we see when compared to, let's say, something like the Case-Shiller U.S. National Home Price Index, we see that the CPI adjustment oftentimes is a poor, has bad correlation to what actual national home prices and indexes are showing as well. So keep that in mind. Inflation right now, as it's being calculated, there's a lot of issues that you can find with the way that it's calculated, but we're going to kind of stick with basically how the government is calculating it as we talk through this. Again, if you can find a number of issues that are wrong with the way the government calculates it, but just for simplicity's sake, we're going to be sticking with the way that the government calculates it. And so again, most of us look at CPI, but this is no longer the way that tax brackets adjust to inflation. This was changed as part of the Tax Cuts and Jobs Act, in fact. In 2017, then put into law in 2018, they changed from CPI to something called Chained CPI. And basically what Chained CPI looks at differently is they have a ability to replace. So what that means is, let's say that bananas, for instance, we're seeing extremely high inflation in bananas. Okay, well, part of normal CPI, bananas are a portion of that basket of goods. And so you'd see that given adjustment. Well, with Chained CPI, they basically take the assumption that people will, when seeing a high inflated price for a good that they will look for substitutions. They will look for replacements. So rather than purchasing bananas, people will purchase apples. And so what effect this has over time, again, everyone's tax bracket, or I shouldn't say everyone, most people's taxes went down because of the Tax Cuts and Jobs Act. But they inserted some small little changes within the tax code that will affect really all of us for the foreseeable future because of this Chained CPI. And so basically what we see out of this Chained CPI is brackets, statistically going back into the past, will have adjusted at about 0.25% slower rate. So if, let's say, inflation has historically been 2.5%, tax brackets will have adjusted at 2.25%. And so what you'll slowly see is as your income is adjusting for inflation, you're being pushed into slightly higher brackets. This is something called bracket creep. Okay. And so just by definition of this change, you'll see your taxes slowly rise because a little bit more income is being pushed into those given higher brackets because brackets have been adjusting slower to inflation. So we see this a lot with stealth taxes in general. I'm going to try to leave off my tinfoil hat here because, again, a lot of conspiracies can be chalked up to just, again, I guess, poor calculations or mismanagement in general. But there seems to be a lot of things stacking up that really hurt consumers, really hurt retirees over the long term because of all these little stealth taxes that have been inserted that will slowly raise tax revenue. And most people will never realize it because they're not focused on those given stealth taxes. The Chained CPI is one of those changes. And so the effect that this will have over time, if we look from 2019 to estimates going forward into the future, you can see basically the gap that's created based on the old inflation measure. So your income is theoretically adjusting to this given change here. Well, they're looking at it in terms of the standard deduction. And basically what we're seeing here is less of your money is not being taxed within the standard deduction because the standard deduction is set to adjust at a slower rate, again, to that chained CPI. So all of these tax brackets are now adjusting to that chained CPI and the impact of new inflation measure on tax collection. Well, again, tax collection goes up. And so it makes a lot of us question, okay, was this done intentionally? Okay. And so let's start jumping into specific tax brackets, specific tax areas. Now, it's important to know that even though we're looking at 7% inflation from December 21 back to December 2020, we see in the IRS come out with inflation adjustments much sooner than that. So obviously they're not looking at just 2021. In fact, if I'm not mistaken, going from memory here, they actually look from August to August. And so they look at the overall change from August to August. Now I went back and looked at Chained CPI from August to August, and we should see about a 5% inflation adjustment based on that Chained CPI's change. Okay, but nonetheless, I'm showing basically what each of these tax brackets, each of these tax standards were in 2021, comparing it to 2022, and then showing the difference here. So, and by the way, I'm showing married filing jointly. I didn't intentionally leave off single filers, but for a lot of these, unless it's different, you can basically cut each of these in half. So for instance, when we're looking at 2022 standard deduction, when we're looking at the 10, 12, 22% brackets, single filers, you basically just cut in half. So rather than including a lot more information and muddying up things, just basically cut in half if you're a single filer. But nonetheless, if we're looking at married filing standard deduction in 2022, it jumped essentially $800 from $25,100 to $25,900, which basically calculated out as about a 3% adjustment. And you'll notice this through time. There's slight differences with rounding. The government tries not to leave, again, an odd number like 25,901, 25,903. And so they round. And so you'll see that there are slight adjustments through time based on each of these. You'll notice that the 10% bracket adjusted 3.27, whereas other brackets only adjusted 3.11%. But you can basically see that even looking at the Chained CPI, we're seeing lesser bracket adjustments or smaller bracket adjustments. And again, this may be made up for when we look at the 2023 adjustments, but the whole point is that taxes aren't adjusting quite as quickly as they should based on that Chained CPI. And so we've seen, again, 5% going from August to the previous August, and we've seen about 3% adjustments across the board. Another important thing to note, a lot of people forget about, standard deduction add-on for those that are over 65 or blind. Single filers, you get a $1,700 in 2021, $1,750 in 2022. Married filers, you get a little less per person, but obviously a larger total amount when both of you are over 65. So that's a standard deduction add-on that you get once you turn and are over age 65. But again, you can notice that each of these brackets adjusted at about the same rate, right around that 3% range. So if your income has adjusted higher, notice that you're seeing some of that bracket creep already. Okay, long-term capital gains, we see pretty closely to the exact same thing. Again, married filing jointly, you can cut in half. For single filers, we're looking at long-term capital gains. Short-term capital gains are subject to these ordinary income rates, but nonetheless, seeing about 3% adjustments across the board. Okay, so again, that bracket creep. We'll talk about something here in a sec with long-term capital gains, that there's actually another type of bracket creep that, again, a lot of people aren't necessarily thinking about. Let's talk through. So thus far, we've been talking about brackets that do adjust for inflation, but we also know from previous videos, stealth taxes, that there are a lot of parts of the tax code that don't adjust to inflation. Net investment income tax is one of those. That's a surtax that was put into law right around when Obamacare was put into law, the Affordable Care Act. That's supposed to be a surtax to help pay for those given programs. And so this is subject to anybody that is over 200,000 for a single filer or shows income over 200,000, you will see an extra 3.8% tax on long-term capital gains. You see the same thing for married, but this mark is over 250,000. And so these are things that there is no intent to adjust these for inflation. They haven't been adjusted for inflation since 2013 when they were put into law. And so what I'm going to do is I'm also going to show if they were adjusted to inflation, what these numbers would be updated now. And so if adjusted for inflation, we estimate the current threshold would be about $241,000 for a single filer and $301,250 for a married filer. So this is exactly what I mean with bracket creep. As we start moving through time and we have certain parts of the tax code that aren't adjusting for inflation, we'll talk about a few that are certainly more top of mind for every retiree a little bit later in this presentation. But we're going to start seeing bracket creep where your income is needing to adjust to pay for energy, to pay for gas, to pay for food, to pay for utilities. And so you're forced to take more income, but these tax brackets, these tax marks don't adjust for inflation, thus pushing you into higher tax rates. Okay. Net capital loss against income is also another one. $3,000. So if you essentially can carry forward a $3,000 capital loss that you can take against your income moving forward. You can take $3,000 a year. You could certainly carry forward much more, but you can only take $3,000 against your ordinary income. This was established in 1977, or at least that was the last adjustment in 1977. And once again, it hasn't been adjusted since. And so this is something, once again, where, again, as our accounts grow bigger due to inflation adjusted returns, a $3,000 capital loss, carry forward loss, isn't the same as it was back in 1977. In fact, if it was adjusted for inflation, we would estimate that this amount would be over $10,000 that you could take and carry forward in additional years. So again, we're seeing another bracket creep. It seems this has been the MO for the government as of late. Basically, rather than making a wholesale tax increase across the board where everyone sees it, it's very apparent and pisses everybody off, we see these slight and smaller changes that most people won't notice inside of their situation. And so, again, not as many people are that mad at that point anymore. Let's talk about another one, primary resident home exclusion. So many of you may know, many of you might not know that if you stay in your primary resident for, I believe it's 2 years, when you go and sell that house, there is an exclusion, a profit exclusion that you receive. For a single filer, it's $250,000. For a married filer, it's $500,000. Okay, and so with real estate increasing at such a significant pace, we're seeing a lot of retirees strategically downsizing right now, downsizing from a much larger home, much more expensive home that's just increased in value, downsizing to a lower cost home, and thus taking the capital out of their home and reinvesting it back into their retirement. So this is very good, but we're not seeing inflation adjustments to this profit exclusion. So for a single filer, you're at $250,000. For a married filer, you're at double that. This was put into law in 1997 and hasn't been adjusted since. And so as we've seen significant increases in real estate values, we should be seeing significant increases in profit, obviously. Your cost basis doesn't change. So this is another sort of bracket creep that we're seeing. Home exclusion, again, was put into law in 1997. If adjusted to inflation, we estimate the current threshold would be $415,000 for a single filer, $830,000 for a married filer. So very significant adjustment when we're thinking about downsize, especially in different parts of the country. Okay, especially out in places like California that have seen some of the largest real estate increase and whatnot, and obviously probably having a lot more profit relative, or a larger dollarized amount of profit relative to their cost basis versus Midwest home prices and whatnot. So that's an important thing to consider as well that will lead to bracket creep. Now, there is something that I want to touch on that's a little bit off topic, but something that's very important to know for primary resident exclusion in the widow trap. So common question that we can often receive is, my spouse recently passed away. What effect does this have on that profit exclusion? Well, the surviving spouse can often get a full $500,000 exemption if the home is sold within 2 years of that first spouse's death. So they essentially can carry that exemption on a little longer, within 2 years. Okay, if the survivor hasn't remarried. The other thing that's important to note as well, that can add an additional benefit if you're using this strategically, is let's say that you're a joint owner in this given house. Well, you get a step up in cost basis. My apologies, I have a typo here. You get a step up in cost basis for half of that given home. And so you can use this strategically on getting the exemption and also getting a step up in basis, and essentially game the system, if you will, in a sense. In fact, if you are in a community property state, you can receive a full step up. So this is something Tony has talked about before in terms of a taxable account. But for those that live in Texas, Wisconsin, California, I believe there are a few other community property states, When one spouse passes away, you can get a full step up. So we should be using that strategically as well when we're thinking about if we're selling our house, depending on our given age. If we have a certain amount of profit, there's some gaming that can be done with maximizing that given exemption and eliminating a lot of the tax on the profit that we might own. Now, this is often overlooked, but again, if you're right around that age, or if you recently had a spouse that passed away and are looking to downsize, looking to move, be thinking about these type of things. Okay, let's talk about retirement contributors. So as far as what we want to contribute to accounts, again, you see things fairly similar here. 401ks moved from 19,500 up to 20,500. That was a 5% adjustment. Part of that is essentially the rounding that happens. IRAs and Roths, 6,000 to 6,000. Again, part of the reason this wasn't adjusted is because, if I'm not mistaken, they look for $1,000 increments, at the very least $500 increments. So it wasn't enough to round up, basically. HSAs went from 3,600 per person to 3,650 per person. And the $1,000 add-on for all IRAs and Roths, for 401ks, for HSAs stayed at 1,000 as well. Because of that rounding, they didn't adjust. So again, things to keep in mind, HSAs only adjusted 1.39%. So from a contribution standpoint, not everything is adjusted to inflation in that same exact way. Likely, if you're still working, your wage is adjusted to somewhat, and you're likely wanting to contribute quite a bit more to these accounts. Well, certain accounts aren't adjusting that contribution limit, certain accounts have. So once again, we're seeing this creep, if you will. Okay, let's talk about gifting. So the gifting amount that can be excluded from having to file a gift return, it changed from 15,000 up to 16,000. So again, this is another one of those rounding, which is why we're seeing a 6.67% overall difference. Now, there is a lot of confusion around gifting. Again, I'm going to take a little aside here and talk through what this gift exclusion means, because a lot of people think, okay, if I go over the 16,000 mark, all of a sudden now I'm going to owe taxes, or someone's going to owe taxes on these gifts. That's not the case. So first off, it's important to know that you can gift per person. So if you're married, each of you can gift 16,000. Okay. And so there's can be some doubling that can happen there. But let's look at an example. This is taken from Smart Asset, actually. They laid out a fantastic example. That gifting amount, when you go over that gift exclusion, it's not as if anybody owes taxes. You have to file a gift return though. So let's say that you gave a gift to one of your children of 216,000 and you're a single person. And so you don't get the double essentially exclusion here. So we're taking the one exclusion of 16,000. So the taxable amount, if you will, is 200,000. Well, that taxable amount is looked at relative to your lifetime gift tax exemption, that estate exemption, if you will. And so it's only after you go over that amount for your life where you will be subject to given taxes. So for instance, in this person's example, and again, right now that lifetime gift tax exemption is $12,060,000. And so yes, you would have to file a return, but there wouldn't be any tax associated. It would just, your remaining lifetime tax or your lifetime gift exemption would drop 200,000. And so a lot of times you can gift a lot more. For many of us, we're not going to be over this by the time that we pass away, by the time that, and so this lifetime exemption limit, oftentimes that exclusion limit, oftentimes doesn't really mean too much. It just means that we have to file a tax return on that gift, if you will. And you can see basically, if you go over that, that exclusion, not annual, that exclusion limit, essentially this is what you would start to see from a gifting standpoint, from a gifting tax standpoint, okay? Let's talk about Social Security benefits, okay? This is one that certainly hits close to home, certainly one we have talked about previously. Good news is Social Security adjusts to inflation. This is one of the reasons Social Security is so powerful for retirees. In fact, in 2022, we're seeing a 5.9% adjustment. Now, this is across all benefits, whether you have filed or not filed yet, whether you filed at 62 or filed at 70. But obviously, we know a 5.9% adjustment in pure dollar terms is a lot larger on, let's say, a benefit that you filed at 70, might be a $30,000 benefit, versus a benefit that you filed at 62, might be a $15,000 benefit or whatever it would have been. I can't do the math in my head as far as what that would be difference-wise, and so Because inflation, Social Security is an inflation-adjusted asset, it's extremely important to have a large Social Security benefit that you're using in your retirement here. Okay, so let's take an example. Let's say in 2021 you had a $2,300 per month Social Security benefit. Well, pretty simply a 5.9% adjustment here. In 2022, your per month benefit $2,435. So this is one part of the tax code that actually does a decent job adjusting to inflation as the government sees it, meaning adjusting to CPI. Now, I think they use something, again, going off memory, CPI-W, if I'm not mistaken. But nonetheless, does a fairly good job at realistically adjusting. It hasn't adjusted to chained CPI, anything like that. Here's the thing, though. How Social Security determines how much tax you owe on your Social Security benefit, or how much of your benefit is taxable, doesn't adjust to inflation. So this was something set up in 1986 and has not been changed since. 1986, 1983. Again, I'm going off memory on some of this stuff. But provisional income, that formula will not change. So provisional income, you take your gross income. So that would be pension income, annuity income, all the money you're taking from your traditional IRAs, capital gains, things like that. Roth IRAs are not included, or Roth IRA withdrawals are not included in that. You would add in your tax exempt income. This would be like muni bond interest. And then you would add in 50% of your Social Security benefit for the year, as well as for your spouse if you're married. And then based on this provisional income, you would plug this into this given table. Now this table, these amounts have not changed since the 80s. These do not adjust for inflation. There is no plan for these to adjust for inflation. So if you're married, if your provisional income is less than $32,000, congratulations, your Social Security benefit is tax-free. Between $32,000 and $44,000, the amount between in this zone, up to 50% of that amount is moved into becoming Social Security taxable. So for instance, let's say your provisional income was $35,000. There's $3,000 within that zone, so $1,500 of your Social Security benefit would become taxable. And then over $44,000, up to 85%. So for every dollar over $44,000 for your provisional income, 85 cents of your Social Security benefit becomes taxable. So what's going to happen over time? Okay, we know that our Social Security benefit is going to adjust for inflation. That's very good. Okay, we know that we're likely going to have to adjust our income for inflation through time. And so what we're going to see over time is this provisional income number rises, which means that we're slowly, even if we start out in this tax-free zone, we are likely to slowly be pushed into having more of our Social Security benefit become taxable. Okay, this is certainly already a case that we see with RMDs increasing through life. The older you get, the larger RMDs you generally have to take. And so this is something we already see, that RMDs force more of your Social Security benefit into being taxed. But let's look at an example of what this looks like. So we're going to take a couple that's taking in $83,000 of gross income. $53,000 of that is coming from Social Security. $30,000 of that is coming from IRA withdrawals in 2021. And so their provisional income in 2021 is $56,500. You can match that up if you just plug it within this formula. And so their Social Security taxability, despite taking $53,000 from Social Security, only $16,625 is taxable, and that's taxable. You would add that back in with that $30,000 of IRA withdrawals. You take out the standard deduction, and then you'd plug that into the given tax tables. So this person is in a fantastic situation, all things considered. They have a very low effective tax rate. 2022, what happens though? Well, their Social Security benefits adjust to $56,127, and let's assume they adjust their IRA withdrawals to that same 5.9% adjustment. So that would now adjust to $31,777. This is keeping up with normal purchasing power. They're basically purchasing, again, if we think inflation is 5.9% for this individual, they are purchasing the exact same things that they purchased in 2021. But because of inflation, they're having to take out more income. Provisional income jumps up to $59,840. And look what happens to their Social Security taxability. All of a sudden, they see almost a $3,000 increase. Well, all things said and done, this is a 17% increase in Social Security taxability. So in general, because of all of these bracket creeping items, because of all these stealth taxes, high inflation is not good for your tax situation. Okay, we've covered this in previous videos. If you're watching this on YouTube, I'll try to link to some of those videos in the upper right-hand corner. But inflation is bad for your tax situation. You have all these things. If the tax code perfectly adjusted to inflation, it wouldn't matter. Your taxes would be percentage-wise the exact same in terms of the relative income you are taking. It wouldn't be that big of a deal. But as we see within the tax code, there are all of these things that don't adequately or accurately adjust to inflation. And so we see tax liabilities rising through retirement. And so the higher inflation that we're seeing, the more it's going to subject retirees to these higher taxes. This, again, comes back to needing a forward-looking tax plan. So again, we see just a simple 5.9% increase in the income that we're taking, and yet we see a 17% increase in the amount of our Social Security benefit that is taxed. And so in terms of talking about something like the Social Security tax torpedo, okay, and again, the Social Security tax torpedo is created because you see higher marginal rates as you're taking income from other sources. There's a double taxation zone. You're taking $1 from your IRAs, let's say, it's forcing $1.85 being taxed because 85 cents is added in and now taxed as well. So there's this double taxation zone. Now for 2022, we might see a retiree that's based on the income they're taking, they're right here in this yellow line where they're being taxed here at the standard deduction, then 18.5% is their marginal rate, and then they see part of their the last marginal rate that they pay around 22.2% in terms of federal income tax. Well, what happens because of this bracket creep over time, as this person's Social Security benefit is rising, their provisional income is rising. As they're taking more from their assets, again, their Social Security taxability is rising. And so what you'll see with this line is it gets pushed over further this way, okay, at a pretty significant rate, as we see 17% increase in Social Security taxability just in this last example. And so this is why you may start retirement outside of the worst parts, the most destructive parts of the Social Security tax torpedo, but as we move through retirement, you'll be pushed into these given parts, okay? Lastly, we're going to cover IRMAA. So IRMAA is an adjustment for Medicare if you make too much. Essentially, the government wants you to pay more of your share of Medicare. Now, in theory, Medicare is designed to have a 25-75 split, with the government taking the lion's share split. Okay, IRMAA is essentially a surcharge that raises half of your split to show if you show too much income. And so there have been a few different pieces of writing that I've read on this that it's pretty interesting about. Only 7% of people are subject to IRMAA. And so when we look at an overall case as far as how much is this actually adding to the overall ability for Medicare to pay a little bit more, meaning that those 7%, how large of a difference are they actually making? Somebody broke this out into math. And basically with those 7% paying a little bit more, the share basically goes from something like 27-73 type of split, which is, again, is it that big of an issue that we even need to have an IRMAA? Again, I'll leave that up to you. But again, it's important to know that IRMAA is based off AGI, not your taxable income. It's a 2-year look back, okay? Now, the confusing thing here is in November, we start to see IRMAA, the IRMAA tables come out. And so for 2022, it came out in November. So we don't yet know, last year, we don't yet know what for 2021, what the IRMAA tables were going to be in 2023. And again, 2023 tables look back at your income on 2021. And so this is another hurdle where this is a tax cliff. Again, putting on my conspiracy hat, you can make a case that this is set up intentionally. A tax cliff means that as soon as you go $1 over that mark, it means you owe that full cost. Okay, so you're subject to increased Part B as well as Part D premiums. So if you go $1 over, let's say in 2020 for affecting what you pay in 2022, if you show $182,001, you are all of a sudden at this next IRMAA step up, this next Medicare premium increase. And so one, we don't know what the inflation adjustments are going to be for IRMAA, and we don't yet know. We can estimate what we're looking at when we're looking at 2022's tax year for what we're going to pay for Medicare in 2024. We don't yet know what the 2024 tables are going to look like. We don't yet know what the inflation adjustments are going to look like. So this makes it very difficult to plan. We have to start making estimations. It usually means we're looking a little bit more conservatively because obviously we don't want to go over that tax cliff. $1 over and we owe that full cost. And so that marginal rate on that extra dollar is obviously substantial, incredible, okay? So IRMAA was enacted in 2007 and initially was not adjusted for inflation. This recently changed, I believe, in 2018. And so we are starting to see adjustments. Now, 2021 to 2022 adjustments in the general amounts. This number was 176,000 in 2022 and 88,000, or sorry, in 2021 and 88,000 for a single filer. And so we saw a 3.5% adjustment moving forward. Okay, how much of that was inflation? Okay, again, leads to questions. And so know that IRMAA is a little bit different. They adjust slightly differently to inflation, but it's very difficult to know what we're planning for in the next 2 years. And so again, you want to have some levels of safety, some room for comfort so you don't go over that given tax cliff. But as we can see, again, there's all of these things that are supposed to adjust for inflation. We're seeing a lot of these not adequately adjust to inflation, or at least this year not adequately adjust to inflation. Again, Chained CPI from August to the previous August was around 5%. We're seeing inflation adjustments across the board around 3%. Okay, but even those things that do adjust for inflation, again, they're just based on that Chained CPI that's already built into a slight bracket lag, a slight bracket creep, okay, if you will. And then there's other things within the tax code that completely just don't adjust to inflation. And so those are things over time. Specifically, one that every retiree will see and be affected by is Social Security. And so again, over time, what you're going to see, the higher inflation, the more that hurts your taxes because of all of these given things. If we see, let's say 1% inflation going forward in the future, that's going to hurt a lot less than if we see 5% inflation, specifically in things like Social Security, something that affects all retirees. And so what does this mean? How can you overcome these type of things? Well, one, having a tax plan that has these given stealth taxes, these given bracket creeps built into it. This is something that we do for our clients. Building a forward-looking tax plan that has this bracket creep and what that translates to in your tax plan. So we might be a little bit more aggressive with something like a Roth conversion, because down the road, we're going to see any RMDs push you into higher brackets because of some of that bracket creep. So it all comes back to having a better plan. And it just so happens that that's our motto. You don't need more money. You need a better plan. You need a better forward-looking tax plan that thinks through all of these given tax hurdles, thinks through inflation adjustments so that when we see higher inflation, we're stress testing that in our plan. And so what's inflation going to do in the coming months, in the coming years? Again, this is a big question mark. Do you know how your retirement, though, is going to adjust and handle that given inflation? We already know that taxes, you'll see a tax liability spike. But what about other parts of your retirement? Okay, allocating to things like low yielding fixed income. Okay, that has obviously hurt drastically by inflation, significantly over this last year when you have essentially yields around, let's say a 10-year bond around 1.5%, and we're seeing 7% inflation. Okay, losing money, stepping backwards in terms of those given yields. And so making sure you have a better plan that adjusts to inflation, that deals with these things that we will see down the road, will lead to more wealth in your retirement. So hopefully this was informational. Again, this was a little bit quicker of a presentation. Hopefully you guys got a lot of value out of this, and we will see you in the next video. Thanks for watching. Let me know if you have any questions down below.